You know that feeling when you're staring blankly at a 30-page insurance policy, wondering if you actually understand a single word of that incredibly dense legal jargon? Yeah, we've all been there. Insurance is notoriously complex. Well, welcome to this explainer. Today, we're diving into a procedural masterclass on exactly how to measure and report customer transparency in the insurance sector. We'll be using the rigorous methodology laid out in the SASB Sustainability Accounting Standard for Insurance. So if you've ever wondered how an organization can actually put a hard number on something as abstract as transparency, you are absolutely in the right place. Let's get started. So, let's kick things off with a pretty provocative question. How much does ambiguity actually cost an insurance provider in the long run? I mean, think about the true cost here. It's a fundamental issue for the entire industry. Insurance products play this absolutely critical societal role, right? They alleviate unexpected economic shocks for people facing illnesses, accidents, or natural disasters. But what happens when the terms of that safety net are, well, a little fuzzy?
According to the SASB framework, unclear policies, ambiguous product terms, and potentially misleading sales tactics don't just result in an annoyed customer. They trigger an absolute domino effect of risks. It leads to an eroded brand reputation, incredibly costly legal disputes, severe regulatory scrutiny, and eventually, customer churn. Regulators might even step in and deem some of these complex policies totally unsuitable for the target customers. This cascading risk is exactly why financial regulators are pushing so hard for the transparency toolkit we're examining today.
Here is our roadmap for this explainer. We're going to systematically break down the value of customer transparency, how to report legal monetary losses, calculating the complaints-to-claims ratio, calculating the customer retention rate, and finally, informing your customers effectively.
Okay, Section 1. The value of customer transparency, protecting reputation and shareholder value. Let's dive right in.
You see, transparency isn't just a feel-good buzzword. It is absolutely crucial for the bottom line. Entities that maintain transparent policy terms and ensure their products are actually sold to well-suited customers directly protect their shareholder value. It's how you avert regulatory blowback and maintain your brand's reputation in a hyper-competitive market where financial strength and customer trust are literally everything. Dissatisfied customers might reduce their coverage or just walk away entirely, and that leads to negative financial outcomes for everyone involved.
All right, Section 2, reporting legal monetary losses, quantifying the fallout from miscommunication.
Let's look at our first mathematical requirement. Calculating the total monetary losses from legal proceedings related to product marketing and communication. The first big question is, what actually counts as a legal proceeding under this standard? Well, the definition is intentionally broad. It includes any adjudicative proceeding involving the entity. It could be before a court, a regulator, an arbitrator, or otherwise. For instance, imagine an independent arbitrator resolving a formal dispute where a customer claims the fine print misled them about their out-of-pocket maximums. That totally counts. The scope covers proceedings related to false advertising, the transparency of the small print, mis-selling products, or overcharging clients.
Now here is where you really need to pay attention to the fine print. What do you actually count for monetary losses? You have to report all monetary liabilities paid out to the opposing party or others. This means civil judgments, settlements, regulatory penalties like disgorgement, and even criminal restitution. But here's a huge pro tip for you. You must strictly exclude your own legal defense fees and expenses from this metric. Why? Because this metric is specifically designed to measure the actual penalties and harms associated with mis-selling, not your internal cost of doing business or paying your own lawyers to fight the case. You also need to provide a brief narrative describing the nature of these losses and the corrective actions your organization has put in place.
Moving right along to Section 3. Calculating complaints-to-claims ratio, benchmarking customer friction.
We're on to our second calculation, which gives us a standardized look at dissatisfaction across all your insurance segments. To get your denominator for this ratio, you aren't just looking at single claims. The standard requires you to calculate this ratio per 1,000 claims filed across all segments and regions during the reporting period. This is what allows for accurate benchmarking year over year. So if you receive 50 complaints for every 50,000 claims you process, converting that down to a per 1,000 ratio keeps your data universally comparable, even as your customer base rapidly grows or shrinks. Now for the numerator.
And honestly, this brilliantly shows just how rigorous the SASB standard is. You can't just count every grumpy phone call your call center fields. Step 1 is tracking the complaints across all segments. Step 2 requires that the complaint was actually reported to an external dispute resolution organization. Think like a state regulator or an official ombudsman service. And finally, Step 3 dictates that you only count confirmed consumer complaints. This means the final resolution by that external organization was definitively upheld in favor of the customer. It's a high bar, for sure, but it ensures the metric reflects genuine, verified friction rather than just routine administrative gripes.
Section 4. Calculating customer retention rate. This is really the ultimate metric of loyalty and satisfaction.
Let's walk through the math here, because it can be a bit of a puzzle. At a high level, your base formula looks like this. First, take your total number of customers at the end of the reporting period. Next, subtract the new customers you added during that same time. Then, you divide that remaining number by your starting base, which is your total customers at the end of the previous period minus some highly specific exclusions. So imagine you close the year with 5,000 total customers, but 1,000 of them were brand new. That leaves 4,000 retained customers. You then divide that 4,000 by whatever your starting number of customers was, adjusting for those exclusions.
Let's zoom in on those denominator exclusions, because this is critical for practitioners. You must subtract 4 specific categories from your starting base. You exclude involuntary terminations due to non-payment, terminations due to fraud, and intentional misrepresentation of material facts. You also exclude the attrition of customers in employer-sponsored plans, whether that was voluntary or involuntary. To understand why, think about it like this. If a company decides to switch their corporate life insurance provider to save a few bucks, those hundreds of individual employees didn't actively choose to leave you. The company did. So excluding these specific groups ensures your retention rate accurately reflects true customer loyalty to your products and isn't skewed by unavoidable structural attrition.
Finally, Section 5. Informing your customers effectively. We're moving from the quantitative math to the required qualitative narrative.
So you actually have to publicly detail exactly how you explain these incredibly dense topics to your customers. This covers product suitability based on their specific risk profile, the underlying cost structures, coverage limits, and the exact procedures for claims payments. Most importantly, you need to detail how you communicate unique policy exclusions, like anti-concurrent causation clauses. In simple terms, an anti-concurrent causation clause dictates what happens when a covered event, like a windstorm, and an uncovered event, like a flood, damage a house at the exact same time. These complex, highly specific exclusions are historically what trigger those external upheld complaints we talked about earlier, so explaining them clearly is absolutely vital.
And keep in mind, transparency isn't just a marketing exercise. SASB requires you to document your communication procedures across the entire life cycle of the customer. You need to disclose the mechanisms used, direct mail, online portals, specialized hotlines, and specify the exact staff responsible. This spans the whole shebang, from the sales team making the initial pitch, all the way to the claims adjusters handling a complex payout months or even years down the line.
To wrap things up, there's a quote directly from the SASB insurance standard that I think perfectly captures the whole point of this. It says, "Entities that maintain transparent policy terms and sell products to customers best suited to them may better maintain their brand reputation, avoid regulatory scrutiny, and protect shareholder value." It really highlights that this is not merely an accounting exercise. It is about building a sustainable, trustworthy insurance business.
So, take a moment to reflect on your own organization based on what we've unpacked today. When you sit down to calculate your complaints-to-claims ratio or track your external legal losses, what story do those numbers actually tell about your business? Is your communication building genuine trust, or are you just hoping no one reads the fine print? Thanks for joining me for this explainer, and keep driving for clarity.